Now, our next speaker is a truly inspirational voice of our generation. She's the CEO and co-founder of Beehive, an internationally recognized behavioral sciences consultancy. She's developed innovative approaches that use behavioral insights to tackle complex business needs, such as overcoming and building customer habits, shaping the perceived values of products and services, and building trust. She's advised some of the biggest companies across different sectors, helping them to better understand their customers' needs, desires, and what underpins their motivations. Please give a very warm welcome to Rachel Altmann.
Thank you for joining. So today I'm going to be talking to you about the financial brain game on how you can win customers through the power of behavioral science. So last year at this conference, there was a stage with relatively little foot traffic, and the organizers and the companies who were presenting there wanted to increase the foot traffic. So how would you do that? And what happened is they placed a slot machine filled with stuffed pandas. If you were there last year, then some of you might have seen it. And suddenly, high-stake decision makers, so some of the most rational, calculated people in finance, started lining up just to win this stuffed toy. And this wasn't rational, and it wasn't logical, but it worked. And this is what I came to call the panda effect, when your behavior is driven less by value and more by the feeling of a win. And if money and status can't keep people from lining up to win a stuffed toy, then what can this tell us about the way customers interact with finance? And it's not just pandas, so think about it. Have you ever received a gift card of, let's say, 50 euros, and you spent it on something you didn't need simply because it felt like Monopoly money? Or have you ever walked out of a shop convinced that you've just saved money simply because it was 30 or 50% off? Or have you ever easily added an expensive add-on, so let's say a 2,000 euro add-on to a fancy new car, simply because the price seemed relatively inexpensive compared to the value of the expensive car, even though you wouldn't have paid for this otherwise? Or have you ever gone out of your way to fly with a specific airline just to earn points or stay within a specific loyalty tier, even though there were other options that were either cheaper or more convenient? And we might laugh at these examples, but I'm sure that we can recognize some of our own behaviors, and we all do these things. And this is the whole point, that finance isn't neutral. Every transaction is deeply emotional, social, and human. So today, I want to take you behind the scenes of what I call the financial brain game on why rewards hook us, how our brains misjudge value, and how understanding these hidden rules can help you design financial products and experiences that don't just capture people's attention, but can build trust, loyalty, and lasting value. So quick question for the audience. How many decisions do you think we make in a day? So you don't have to answer, just think about your answer. And let me ask you a second question. How many of these do you think are unconscious? So think of a probability, a percentage. Well, actually, we make approximately 35,000 decisions a day, and 90% of these decisions are unconscious. And this is where behavioral science comes in, because through behavioral science, you can help understand both the conscious and unconscious decision-making factors that influence our behavior and harness them to influence behavior where it matters the most. And this is where Daniel Kahneman's Nobel-winning framework or concept gives us a useful lens, the so-called System 1 and System 2 thinking. Maybe some of you have read the book Thinking Fast and Slow, so then you would be familiar with this concept. But this is the idea that our brains use two different operating systems, System 1 and System 2. System 1 is the more unconscious, automatic, and intuitive fast decision-making. And System 2 is the conscious, rational, deliberate, and more logical and reflecting decision-making. But as you've seen with the previous numbers, you can already guess that 90% of our decisions are made in System 1. And the truth is, while we might like to think that we tend to utilize system 2, especially within the realm of finance, the majority of our decisions, including our financial decisions, are driven by system 1. So rational thinking is really the exception rather than the rule. And this matters for finance because if we want to influence behavior, we can't just design for the rational system 2, but we need to recognize how powerful system 1 really is. So we've seen that we make a lot of decisions a day, and the majority of these are unconscious, so you can already guess that human rationality has limits. And we operate within something called bounded rationality. So we are imperfect, and we have cognitive limitations, and we are unable to absorb all the available information out there, which can lead us to imperfect judgments. So you can see the 4 key limits summarized here within the concept of bounded rationality. So we don't have access to perfect information. We don't have the cognitive capacity to process all of the available information out there. Our memory and recall are not perfect, and we can't have enough time to gather all possible information and assess all of the potential actions we can take. So perfection and rationality are costly, but this is good actually because imperfection is key to our success. So this actually developed during evolution, that when humans who used more time and energy that was necessary to make decisions were less successful than those who could make quick and less effortful decisions. So fast decisions actually often mean survival. So just think about it. If you see a fire or a bear approaches you, you can't stop and start comparing different options, but you're going to have to listen to your intuitions and act quickly. So our brains rely on shortcuts that help us make quicker and better decisions, especially when we have bounded amount of time and when we have limited information or under uncertainty. So this brings us to the idea that humans think and behave in recognizable patterns, and we are predictable. So this is the idea of heuristics and biases. Some of you might have heard this term, but because we make so many decisions a day, we tend to satisfy. And satisficing means simply that you stop at a good enough solution. So if you go to a supermarket and you have to purchase, let's say, a bottle of milk, you're not going to rationalize and compare all of the available options, but you're going to stop at a good enough outcome, and this is what we call satisficing. And in these situations, we rely on shortcuts and rules of thumb that govern our daily decisions, and this is what we call heuristics. But because we rely on these heuristics or shortcuts, we tend to be susceptible to cognitive biases. And cognitive biases are simply systematic deviations from rational choice. So actually in finance and also outside of the financial domain, there's many cognitive biases that shape our behavior that can seem irrational, but are actually very much predictable. So here you can see an image of the famous cognitive bias codex. There has been hundreds of biases that research has uncovered, and I really recommend that you check this later if you want to find some of your own biases and maybe recognize some of the biases that you know. But today we're only going to go into a couple of these. So let me ask you another question. What do you think? Which of the following is more effective in reducing plastic bag usage? Option 1, a 5-cent discount on purchase, or option 2, a 5-cent tax on purchase. So raise your hand if you think it's the first one, and raise your hand if you think it's the second one. Exactly. So what we see actually, that when introducing a 5-cent tax on purchase, we saw a plastic bag use dropping by 42%. And when the exact same amount was introduced or framed as a gain, so introducing a 5-cent discount, then we saw 0% change in behavior. And this is what we call loss aversion. So the idea that avoiding losses can outweigh seeking gains. So loss aversion states that losing something feels about twice as painful as gaining the same thing feels good. So a 5-cent loss feels more painful than receiving a 5-cent gain, the pleasure gained from that. And actually in finance, this is everywhere. So customers, for instance, tend to be more upset by getting a €5 fee than by getting a €5 bonus. And this is the same idea why investors hold on to losing stocks longer, because they want to avoid locking in a loss. So loss aversion is all around us, and it's especially relevant within our financial behavior and within the financial domain. Let me ask you another question. So a quick poll. Would you rather choose 100 euro today or 110 euros in 1 month? Who would choose the first one? Okay. And the second one? Great. Let's change this a little bit. How about you could choose 100 euro in 1 year or 110 euro in a year and a month? Who would choose the first one? And who would choose the second one? So similarly to what we see here, this is what happens. In the first case, when you can choose the 100 euro today, 82% of people chose the 100 euro today. But when we made the same decision in the future, it dropped by more than half, down to 39% of people choosing the 100 euros in a year. So the key idea here is in both cases, we see a difference in waiting of 1 month and an extra 10 euros. But we see when the choice is immediate, most of us tend to go for the smaller, sooner reward. And this is what we call hyperbolic discounting, or the most common term, what we call present bias. And this is the idea that now beats later. So this is our tendency to overvalue immediate rewards over future ones. And this bias can actually explain why people undersave for retirement, why credit card debt can pile up, and also why payday feels so irresistible compared to long-term planning and putting that money aside. And this has a lot of financial implications because the future feels very distant. And if we want customers to invest, save, or really be more present, future-focused as well, we can't just tell our customers that you will thank yourself later, but we have to help them bring the future closer to the present. So by visualizing retirement savings, giving instant rewards for long-term actions, and helping them tackle the hyperbolic discount by making rewards seem closer to our present. Another question for you. What do you think? Which is a more likely cause of death? Dying from falling airplane parts or dying from a shark attack? Raise your hand if you think it's from dying from falling airplane parts. Okay, and raise your hand if it's from a shark attack. So most of you believe it's the shark. Actually, it's significantly more likely to be killed by a piece of falling airplane part than by a shark attack. Actually, 30 times more likely to die from falling airplane parts. But just like most of you got it wrong, most people, when asked this question, tend to get it wrong. So why do you think that happens? And this can be explained by the availability heuristic, which is what's vivid or what's memorable and easy to recall feels much more likely. So this is our tendency to rely on easily accessible information and single memorable moments when we're making decisions about the future and when we're predicting probabilities. So in finance, this happens all the time. People buy insurance against rare events because maybe they've seen it in the news or they got scared from memorable information or something happened to a close friend of them, while we tend to underinsure the boring, less interesting ones. So if we want customers to make better choices, we can't just throw probabilities at them, but we need to make the boring but important risks feel salient and real as well. So far, we've seen that humans aren't perfectly rational agents, and we're driven by shortcuts, we're driven by our biases, and we're strongly driven by emotions. And also, we tend to jump between system 1 and system 2 decision making. And we've also seen that our financial behavior is not random. It follows patterns shaped by how our brains are wired. So this is why, if we want to design the right financial game, we need to understand the rules which our brain is already playing by. So this is what we're going to do next. We're going to go a little bit deeper and try to understand our psychology of money. And there's 4 key rules or 4 key layers that can help us understand this. The first layer is how we feel about money. So these are the emotional reactions and reward systems that can spark our decisions. The second layer brings us to how we think about money. So these are the stories, the identities, and the perceptions that give money its meaning. This brings us to then how we engage with money, so how motivations and habits can form and how we can turn our intentions into actions and to long-term behavior change. And finally, we arrive to behavior, so how we behave with money. And these are actually just the visible choices and actions we make that are influenced by all of these hidden layers that I've just mentioned above. So now we're going to go into each of these layers and try to better understand our psychology of money, which can later be utilized to then be able to influence behavior. So let's start with how we feel about money. So before we even think or act, financial stimuli triggers very powerful responses in our brain and body. And these reactions, whether that's the dopamine, anticipation, or our emotions, they shape everything which follows next. So it's essential to start from how we feel about money to really understand the psychology of money. So imagine that you get a small bonus at work, or you're expecting a small bonus at work, and it actually turns out bigger than you expected. So this positive emotion or this rush that you feel, that's dopamine firing. And when reality exceeds our expectations, the surprising extra trigger can burst dopamine into your brain, and creates this buzz of excitement. However, the problem is that our brains learn incredibly fast, and we tend to update our expectations very quickly. So to get the same satisfying buzz the next time, we will need an even bigger reward. And this is the idea of this endless loop of better, which you can see up here, and it's often called the hedonic treadmill. So the name is very telling on its own. It simply says that yesterday's win can feel ordinary today, so we really quickly update our information, and it's going to be hard to satisfy and get the same level of happiness unless we update the expectation and get a larger reward. And maybe you've heard this concept through the happiness income paradox. Maybe people have told you, or you've told some people, that more money doesn't make you happier. And to some degree, this is of course true. It's the same idea here. If you get a raise, you might be happy for a couple days, weeks, or even months. But after that, you're going to update your expectation. This will become the new normal, and you're going to need a bigger raise to satisfy the same level of happiness. And there's something else that's really fascinating that's relevant to mention here, which is the seeking system. And this is the idea that our brains aren't just wired to enjoy a reward, but they're wired to seek rewards. So as you can see here, the chase excites us more than the catch. Often seeking a reward, so the anticipation of that reward, brings just as much value as the outcome or reward itself. And this is very important because for financial engagement to thrive, you need to create anticipation and not just focus on outcomes. So it's the same idea with micro wins, visible progress, which is what keeps people coming back and keeps the suspense for people to come back and engage with your services or products. So here the key idea is how money makes us feel can really shape how we see it, how we value it, and ultimately then how we use it. So this brings us to the next layer. We've just covered how we feel about money, to how we then think about money. And this can be divided into multiple layers, the first one being money as identity. So we know now that money isn't neutral. It's actually deeply personal, and it's often actually seen as a self-extension. So it's an extension of yourself, and the way we handle money is also describing our self-concept. So the stories we tell ourselves about who we are. So money isn't just a resource, but it's actually part of the self. And there's also something called the identity-linked money attitudes, because our identities and the way we see ourselves and our self-story then influences our attitudes towards money and towards finance. So this can be when you feel you're a saver, you're an investor, maybe you're a responsible spender. All of these identities are formed through the self-extension. And there's another layer here, which is the future self-connectedness, which simply means that if you feel connected to your future self, so you feel that your future self is me, then it will be much easier to save for the future because it's going to feel like self-care. But if you don't feel as connected to your future self, then delayed gratification will become much harder, and you will tend to prioritize short-term rewards and short-term outcomes. So when money reinforces identity, behavior becomes not just what I do, but it will become who I really am. However, identity doesn't exist in isolation because it's deeply social, and we can constantly compare ourselves to others to try to figure out what's normal or what's aspirational. And this is the idea of social norms, which are simply the unwritten rules that guide how we behave in groups, especially in cases of uncertainty. So just think about it. If you're, let's say, go abroad and you're trying to find which restaurant to go to, and there's a restaurant that's full and there's a restaurant that's empty, and you have no information, you're more likely going to go to the one that's full. And this is simply the wisdom of the crowd. You will believe that the people who went to the one that's full have some information that you don't know, so you're going to be following the crowd. But if we check an example in practice, this is actually very powerful. So for instance, telling taxpayers, this was done in the UK, that 9 out of 10 of your neighbors pay on time boosted compliance dramatically, so people significantly increased their outcome of paying their taxes on time. So this is a very powerful intervention, because we see that by giving this information, we're not just giving information, but we're actually designing motivation. So these cues don't just inform us, but they help us motivate to catch up with peers, to feel proud when ahead, and also to avoid the shame of falling behind. However, when you frame social norms poorly, it can backfire and have a negative spillover effect, because if the gap is too large between your current behavior and the one that you see to be normal or aspirational, then it can lead to demotivation or even disengagement. And the third layer here, so we talked about the identity, the self-identity, we talked about the social implications, and this brings us to one more layer, which is money as context. And we tend to say that money is fungible, so 10 euros equals 10 euros, which theoretically is true, but our brains disagree and we tend to treat money differently. So the idea that money is a neutral means that its meaning really strongly depends on the context and on where the money came from. So we can see that it can be influenced through different elements, such as the source. So for instance, you treat a tax refund as free money, which is of course not rational. It can be influenced by the connotations, by the framing of the money, and also by the medium of transaction. So for instance, we know that by paying by card or digitally will significantly reduce the pain of payment, because it will feel more abstract and we will have a material disassociation. So the key idea here is the same 1,000 euro can have very different meaning and really influence on then how we spend it and how we treat it and how we feel about that money. And once we bring all this complexity together, we can see that individuals are actually very complex, and there's multiple layers that influence on how we deal with money and how we perceive value. And this very beautifully comes together to show the perceived value framework. And this is a very useful and simple framework to use when you're trying to maximize the perceived value of your products, services, or the experiences you create. So the first one is the functional benefits, which is one of the most common ones, especially within finance. Does it work? Usability, reliability, is it efficient? It can be price, speed, security. So banks and financial institutions tend to focus very strongly on the functional benefits, but often the other three key value dimensions are forgotten or not utilized enough. So the second key value or benefit are emotional benefits. So how does it make me feel? This can be nostalgia, trust, pride, or joy. The next one is social benefits or social value. So what does it signal about me? It can create a sense of belonging, a social status, or social connection. And then the fourth one is the personal level. So does it align with my goal, with my identity, with my beliefs and values? And the key message here is that it's essential to utilize all levels of the perceived value framework to be able to maximize value of your products. And here, just to strengthen that point, I brought a quote from Stephen Bartlett's book, The Diary of a CEO. And this quote is from Rory Sutherland, the vice chairman of Ogilvy. And I just want to read this to you to really show the power of perceptions. So he says that it's hard to increase customer satisfaction by making a train 10 times faster. It's actually much easier to increase customer satisfaction by using psychological principles to make it feel 10 times more enjoyable. So this is the key, that you don't always need to create a fancy new feature, making it faster or making it better, but it's often the perception that can really drive our behavior. So it's essential to understand how you deal with perception and how you can influence perception. So this brings us to then how we engage with money. So we haven't touched on trust yet, but of course the key psychological foundation before we can talk about engagement and motivation is to build trust. But once trust is in place, motivation can emerge. And in order to deepen motivation, there's three key psychological needs that need to be met. The first one is autonomy, which is how customers feel. Are they making informed and free choices? And are they being able to be independent and not being coerced? The second one is competence, so whether customers feel capable, supported, and effective in making their decisions. And the third one is relatedness, so whether customers feel connected, recognized, and validated in their financial journey. So what's essential is that once these three are met, that's when motivation can deepen, and that's when a motivation can be sustained. So I'm not saying that if one of these are missing, then you're not going to have engagement within your products, but it's going to be much easier to break, and to really deepen that engagement and create lasting loyalty and value, you're going to need these three psychological concepts to be met. So once we have this, then it's essential to move on to habits. So it's one of the key things we want to achieve, but we know that habits can be very sticky. It's very hard to overcome bad habits or to create new healthy habits. But once motivation emerges, we need to then see how we can keep people there. So there's something called a habit loop, which shows how habits are formed and how you can create long-term habits. The first one is the trigger, which is simply a cue or reminder that can start or initiate the behavior. Once we have a trigger, then we can move on to the routine, which is the actual behavior that we want to see. And once we have the routine, then we have the reward, which is what our brain gets out of it. And if this reward has a positive emotional connection, or it's a positive reward, that's when the habit loop will want to repeat the next time the trigger pops up. So the key idea here is that motivation can get people through the door, but habits are what really keeps them there, and you need to understand how habits form and how you can create sticky habits to build financial hygiene. And it's also been found that habits form much stronger when it's actually linked to your identity and your self-connectedness. And this brings us to the last layer, which is behavior, on how we behave with money, which is simply the visible outcome of all of those hidden mechanics and hidden forces which we've just covered. So behavior is really only the tip of the iceberg, and by applying behavioral science, it means you're influencing the invisible drivers or the invisible mechanics to be able to form or shape the visible behaviors. So we've seen that behavior is just the tip of the iceberg, and we need to care about what's underneath. And to create real behavior change, we need to design perceptions, emotions, and habits beneath the surface. So let's just stop for a moment and see what we've covered so far. So we've seen that behavior is extremely complex. We've seen that we're influenced by our biases, but we take different shortcuts, and our emotions play a strong role in how we behave. We've also seen the different layers of the psychology of money. And now we're going to move on to the change phase, and then how do we utilize all of these insights to then influence behavior. And the first level that I want to talk about is to shape perceptions and the importance to deal with perceptions. So we've seen that money isn't neutral. So if we want to change behavior, we cannot just focus on the product features, but we need to be able to shape the way people perceive those features. And there's three key things that I want to highlight here. The first one is to add hedonic value to functional products. So we've talked about the perceived value framework, and we've seen that banks often deliver very much on the rational and functional side, like security, speed, and price, but it's essential to add the other three value dimensions because customers act on how value feels. The second key idea here is to use identity cues and social proof, because we've seen that we make decisions based on how others act around us, and our social identity is a key in how we engage with the world around us. So we don't make decisions in isolation, and we tend to look at how others behave. So this is not only informing us, but it's actually driving motivation on how we then behave. And the last thing here is to frame value, not just how customers feel, but not just what it is, but how customers actually feel about it. So how you can build relevance, trust, and empathy and connection, and going beyond mere transactions. Because what we've seen is that perception is what drives behavior. And here's just a quick example to make it a little bit more concrete. So there is something called the attribute versus benefit appeal. So the attribute appeal is simply promoting a product in terms of what it is, in terms of the feature. So let's take an umbrella. It can be the color, the size, whether it has a wooden hold, or any other functionalities that you see. But there's another way you can describe an umbrella, which is the benefit appeal. So emphasizing the personal results of owning or using that product. So for example, it protects you from the rain. So if you bring this a little bit more to finance, you can see an attribute appeal example on the left. This is just a snapshot of N26, different package comparison. And here you can see that it's promoting the product in terms of the specific features, free ATM withdrawals, space sub-accounts, deposit limits, etc. But on the other side, you can see an example, a really powerful example from Revolut on how they utilize the benefit appeal. So what they've done is they wanted to sell or showcase the Revolut eSIM. And you can see here on the left picture, my Instagram story without data abroad versus my Instagram story with Revolut eSIM. So here what we really see is they're shaping perceptions by showing the outcome of owning that product or feature, rather than talking about how many countries it's available, whether it has a very competitive pricing, or anything else around that. The next key point is to empower our customers. So we know that knowledge isn't enough, because customers know that they should save more, that they need to manage their debts better, or manage their savings, but we see that often knowing doesn't translate to doing. So empowerment needs to go beyond information, because it's about how you build confidence, how you build self-efficacy and control to prepare the customer this readiness to act. And it cannot be a one-size-fits-all. So you need to tailor the support to the different life stages and contexts. So for example, looking at the younger generation, for instance, responsible spending habits, or looking at a bit older generation on how we can simplify digital tools or card usage. So it has to be personalized, and we have to understand the needs and support of the specific target group or behavioral segment we're talking about. And finally, the key point here is you need to nurture financial consciousness, because confident customers will engage with your products and services much more deeply, and they are the ones who will become the ideal customers, which will create more value both for your products and for your company, but also for themselves. The next key takeaway or key insight is to build habits and to learn how habits can be formed. So we've talked about the habit loop, but I want to talk a little bit about how we can design for habit triggers. So we've seen that the first step of the habit loop is a trigger. And there's 5 key triggers that can play out here. The first is time. So for instance, it's payday, you receive your salary, and you automatically transfer a certain amount to your savings. It can be mood, such as stress can cause impulse spending or impulse buying. It could be location and context. So for example, you arrive to the office and you check how your investments are doing. It could be a preceding action. So for instance, when you pay with Revolut, then that means you're going to be splitting the costs. Or it can be other people. So you can see your friends joining a roundup savings or joining the step challenge, and then you're going to feel the pressure to join as well. Once we have this, we need to add gamification. So breaking a streak, or for example, bringing in different gamified elements so people can make their habits more sticky. And once we do this, we need to make sure that these all align with customers' goals and customers' needs, and it feels personally meaningful and personally relevant. And finally, through all of these, you can embed them into your daily routines so people don't just engage with your products temporarily, but they will stay with it, they will trust it, and they will grow with you for the long term. And finally, the last point here is to delight your customers and to spark delight. So we've seen that interest fades over time. A new reward or a shiny feature or service can feel exciting now, but customers really quickly adopt. And what delighted them yesterday will become the new baseline today. So this is the hedonic treadmill we talked about at the beginning. So if you want lasting engagement, you need to anticipate their needs and manage the so-called experience curve. So positively surprising the customers with timely innovations and fresh experiences, ensuring that you spark delight throughout the experience. Because we've seen that delight fuels anticipation, and this is what creates that buzz of excitement that will keep customers coming back and engaging with you for the long term. So far, we've explored how to create deeper engagement. We've shown that we need to shape perceptions, we need to empower our customers, we need to build habits, and we need to be able to spark delight and delight our customers. But if we zoom out a little bit, we see one thing, and one thing becomes clear. That technology alone will not define the future of finance. The real future of finance also needs to be focused on trust, identity, and human behavior. Because we see that customers don't just want efficiency, but they want experiences that feel relevant, meaningful, and personal. So that means you need to understand your customers, which is, we covered this a little bit, how you can go deeper underneath the top of the iceberg to really understand what drives human behavior. We need to be able to predict the needs before our customers even articulate them. We need to be able to personalize the services so they resonate at the right moment with the right target group. And finally, we need to be able to influence behaviors in ways which can empower, build confidence, and deepen engagement. So the key message here is the real future isn't just about faster transactions, but it's about deeper engagement. And those who will design for human connection will be the one who lead this game. Thank you very much for your attention.